Hello and welcome to Any Answers Answered for November 2021. As ever, Tim and I have had a look through the pages of Any Answers and come up with a couple of questions to have a look at today. Our first question today, Tim, comes from the rather wonderfully named Penelope Pitstop. Presumably she is after our Hail Pale. I apologise, I couldn't resist that one. She has a question about landlords, capital allowances, all that sort of thing. Individual landlord has bought a desktop computer specifically for managing his rental business of 3 properties. The business use on it is approaching 100%. The reason they're confident it's 100% is this person has another computer for personal use and all that sort of thing. Penelope is concerned because, having had a look at various capital allowance manuals and also some other comments, her concern is it would appear no rental tax allowance is available for purchasers because the desktop and monitor are used in a dwelling house that the client, which is of course the client's own home in this particular story. The question therefore, is that right? Now I would argue that I think Penelope has taken the wrong dwelling house in terms of what that rule means, and she might be barking up the wrong tree, I suspect.
Well, before we follow Penelope up any tree, let me ask you this. From time to time, I will submit to our software company a claim for reimbursement of perhaps a new monitor for a computer. Now, do we capitalise that and claim capital allowances or not?
I think we just put them straight through as a revenue expense.
As a revenue expense. And that, I think, and it does come out in some of the answers to this thread, is a point worth making. It may well be that you could take the view that these items, the computer and screen, are of low enough value to be expensed and genuinely claimed as a revenue expense rather than treated as plant and machinery. But having said that, the tree up which you've described Penelope as barking is the one that denies a landlord capital allowances in respect of plant and machinery, for example, a washing machine used in a dwelling house. And the legislation specifically refers to plant and machinery used in a dwelling house, but clearly what that is relating to is a dwelling house that is a rental property. Whereas here we're looking at equipment that the landlord is using not in one of the rental properties, but as part of the management that he undertakes of his property business. And I should say that the legislation for capital allowances provides for plant and machinery allowances where the plant and machinery is used in a qualifying activity, and a UK property business is indeed a qualifying activity. So if we're to capitalise this equipment, then I would say, yes, you can claim capital allowances on it. It is analogous to a landlord claiming capital allowances on a lawnmower that they use to mow the lawns of rental properties that they rent out. So I think that the dwelling house issue is a red herring, and unless you're going to decide to expense it and claim it as a revenue deduction, I would have no difficulty in claiming it as a capital allowance.
The way I've always explained it is that it's assets used in the business but not used in the property that you're renting out. So things like, as you say, lawnmowers or a ladder that you use when you have to go around to mend things in the house, that would be fine. It's just stuff you leave in the house with the tenants that would create the problem. Our second question comes from Adzuki. Again, a question relating to working from home, but this time it's a director. And the question is, he's got a client working from home, previous accountant has calculated use of home as office at around about £6,000 a year for the last couple of years. He points out fairly obviously this is not something that is using the flat rate and therefore has been calculated specifically. But his client hasn't provided him with the data to calculate this properly. So in that situation, quite simply, what should he do?
Well, the first fact that needs to be established, and in fact is inherent in the question, is whether we're looking at a self-employed taxpayer or an employee. And in fact, the questioner does say in brackets, sole director. So we're not looking at self-employed. If we were looking at self-employed, then you would be looking at a use of home as office claim on the basis that we can claim the proportion of the expenditure on gas, electricity, mortgage, interest, council tax, insurance, gardeners, cleaners, whatever you like, window cleaners. We're claiming a proportion of that, the business proportion, 10%, you'd have to justify it, but you would, of course, need to have the records as you and I keep, because we make such claims against our partnership income, and you need to be able to substantiate the proportion of those bills that you're claiming. But here we're talking about an employee or director shareholder, and there it's different. And they are not entitled to such a claim because they would have to show that the expense was incurred wholly, exclusively, and necessarily in the performance of the duties, whereas you and I simply have to show that the expense was incurred wholly and exclusively, or that proportion of the expense was incurred wholly and exclusively for the purposes of our trade or profession. So what do we need to know? Well, we need to know exactly the arrangement under which the client's company is paying her £6,000 a year, £500 a month. Now, the only way in which there could be deductibility for this is if there has been a license agreement entered into between the director and her own company, under which the company may occupy that part of her home for the company's business in return for a payment of, say, £500 a month. Then she would need to include the £6,000 a year as rental income, but would then be able to claim as a deduction the costs being the appropriate use of home as office costs and subject to the same requirement to have evidence. So there's a bit more to it than the original question indicates. It's not just a question of what do I need to ask her for in terms of evidence of the expenditure. Actually, first, I want to see evidence that there's a license agreement. And then I want to see on her tax return a UK property business with rental income, but against that, the claim for the expenses.
So the hugely important point to pick up is that distinction between self-employed and director or employee. With one, we can go with the normal use of home as office and calculate a percentage, but with a company, we need to be into rental agreements, we need to show licenses, leases, things like that, and make sure there is a clear relationship between the company, not just the individual deciding to take an amount of money. Thank you for your questions this month. Thank you, Tim, for answering them. Do keep posting in the pages of any answers, and maybe next time it will be your question that we're having a look at. For today, bye-bye.